Good morning, everybody. Welcome to Tuesday's Flow Show. Hope you're all doing very well. Good morning, Kay.
Good morning, Ryan. Good morning, everybody.
Cool. How you doing, mate? Enjoying a bit of wet weather for once?
Yeah, it's going to be doing a lot of good to the grass and flowers and everything. So let's hope it continues, but without flooding, yeah?
Yeah, exactly. My lawn is absolutely yellow. So a bit of rain will go down the storm over here. Just not too stormy. Right, let's jump straight into it then. And just a few bits and pieces out overnight and yesterday. What we'll do is just start with a couple of things. Japan is going to consider stopping their daily COVID number reporting. So they're joining a whole host of other countries who are seemingly just going to move on with the virus at the moment. So we're likely to lose any reporting there about the COVID situation unless it's just purely from the presses. That they're considering doing that, so it's not official yet. So we'll keep an eye on that.
SWB audio
the RBA minutes were out overnight. Nothing really of note in there. They're going to continue on their path of tightening policy. They did say that the global outlook has tilted to the downside, and the CPI, they expect CPI to peak later in 2022. But other than that, not really anything massively on note there. China, they've done a bit more messing about with their property sector. They've got one of their state-owned insurance companies, regulators. They're going to support the property sector by providing guarantees for bond issuances by some developers. So again, it's another situation where they're going to be stepping in and effectively propping up the property sector, if you like. There was also some comments out from the NDRC, which is the National Development and something Centre. Can't remember what the R stands for. They're going to look to boost employment as well as some other measures as well to boost the economy. We did hear yesterday that in Sichuan province, factories were going to be closing down between the 15th and 20th of August to preserve energy supplies for residential people. That comes, I didn't know the context yesterday, but that's coming on the back of a big drought or long-lasting drought happening over there, putting pressure on energy supplies there. So that was the reason for that one. Looking at the currency, the PBOC fixed the midpoint of their rate for the yuan at 6.7730. Now this was quite a jump over the 6.7410 they fixed it at yesterday or the day before. Now the fixings are fairly important. Now you've got to remember there's two obviously
SWB audio
markets. There's the onshore
not
one,
registered.
CNY, and the offshore one that we can mostly trade, which is CNH. And this is in respective of CNY. Now, the reason why these fixes can be a bit important is twofold. One, they can obviously be a bit of a catch up because obviously the market jumped yesterday. One got sold off yesterday over the data and the changes in some of the lending rates that happened there. So the fix is a bit of a catch up, and because the PBOC aim to keep the one in a 2% band from the midpoint. So that midpoint fix is 6.7730. So they look to keep the exchange rate within 2% plus minus either side of that. Now, in some cases, these fixes can be looked at as to whether the PBOC are going to allow the one to move significantly. In this case, I think based on yesterday, this is more of a catch-up move rather than a front-running move, if you like. But these fixes can be very important to, as I say, to determine how far the PBOC will let the currency move. And just on that quickly, I'll bring in Kay because I know we tend to look at these fixes now and again when they become important, and then sometimes they lose their importance. What do you make of the move overnight, Kay?
Yeah, I think well, yeah, you're spot on. It's a way of directing the markets towards where they're thinking. What I spotted as well overnight was an article talking about two PBOC and Communist Party supported newspapers saying that PBOC may do more and have to do more to support the economy. And next week we are expecting, if I recall correctly, another move from the PBOC. Then on the more longer term interest rates, the thing is the 10 BPs they did wasn't spectacular as such. A reserve requirement would have a more direct impact on the currency, but for the local community, it's more important to bring interest rates down, because that would allow them to pay their mortgages and such. But it's interesting that those two newspapers came out relatively at the same time, talking about more support. So we'll have to keep a very close eye on what's going on there for the Chinese yuan. And as you say, we are trading CNH. So what they are doing with the CNY fixings is really showing to the locals and with a wink towards the foreigners to tell us what their plans are with the currency. So as long as they fix higher, it should leave the door open to some speculation that they will let the yuan weaken a little bit. At the same time, I meant to have read that their U.S. Treasury holdings are gradually going down. I wouldn't think that is very supportive for the yuan either, but that thing can really go two ways. It's a double-edged sword. The last thing about this fixing I would like to say is that Reuters produces an expected fixing every morning, like quarter of an hour, half an hour, or even an hour before the PBOC actually fixes it, based on a basket of currencies. So an extra little interesting thing is to watch whether they fix it above or below the expected fixing rate, which today was roughly bang on the money. I think it was like just 3 pips away. But that's another little George of knowing whether they are just catching up or want to direct things.
Yeah, I've never seen that Reuters estimate anywhere close to the money, but it was pretty close. I think it was 6.43, sorry, 6.7743 or 41 was their estimate, and it came out at 6.7730, so a bit close on that one. And I think the next rate change is going to be the 5-year lending rate, which I think is either Sunday night or Monday night. That's the one you were talking about. Correct. That's the next decision on there. I wouldn't expect it really to be much of a market mover, because they can tend to move all these ones in the same direction at the same time. So while yesterday's was may have been a bit of a shock for the market, this one won't be so much of a shock. But you know, it depends on what they do. They've only gone 10 pips on the last 2 rates, so we'll see what they do with that anyway next week. In the meanwhile, looking at some of the data and just taking a look back at yesterday, probably the biggest item on the data docket was the Empire manufacturing, which is the first manufacturing data for the US of the new month. So it can be seen as a bit of a bellwether. And as you can see there, an absolute collapse in the number. They expected at 5.5 from 11.1 that previously, came in at minus 31.3. And all the subcomponents were softer as well. Employment, prices paid, new orders, particularly down as well. So for manufacturing, it's looking potentially like we're going to get another soggy month. We get the Philly Fed on Thursday, I believe, and that's the second number. Then next week, I think we get into the PMIs, and then obviously after that we go to the big ISMs. So really soft number there as well, again for manufacturing. So we're going to be looking to see how that translates into the rest of the manufacturing data. On the housing front, we had the NHAB for August, National Association of Home Builders or House Builders. Came in again softer, 49 versus 55 expected and prior. Now this dropped last month from 65 to 55, and this thing usually only moves 1 or 2 pips at a time. So this is really quite significant, even though it's only a private, fairly small data point. It is significant. Lots of talk amongst those members of the NHAB that the housing market is potentially in a recession now. We've been talking obviously about the housing market being really affected by rate hikes, and we've been watching this for several months, as some of you may know in the chat room and on here. The last domino to fall is going to be house prices, because although we've seen softness in some of the main numbers, house prices have been holding up, which can suggest people are still willing to purchase houses and pay up for them. So although there has been a drop in activity, the fact that people are still paying up for houses keeps the market fairly buoyant. If we start seeing prices collapsing, then we're going to know that rate hikes are really going to start biting, which may then start to feed into the, one of the Fed's tick boxes of slowing demand in the economy, wholesale, and the housing market will be one of those items. And if prices start dropping, they'll put a big green tick in that. If they manage to put big green ticks in slowing demand across the economy, that's when we're going to start talking about the terminal rate for hikes and how high they're going to go before they stop. So take the sectors, each one. If they get a big fat tick for slowing demand, then we're getting closer to the end of rate hikes. That's why I'm monitoring to see the effects of these rate hikes and how the economy is doing. We're still a fairly long way before they even think about stopping hikes, but that's why we watch the data to see how it comes out. This morning we had UK employment as well. I'll just pop that up for you as well. Fairly decent numbers there. Employment still growing. 3-month employment up 160,000 there. A little bit of a miss of expectations and not as much as last month, but it's been growing and growing and growing. Wages are a bit all over the shop at the moment. High if you take out bonuses. There, the ex-bonus number 4.7% higher than the 4.4 previously. If you include the bonus numbers, it beat expectations but was slightly down from last month. The claimant count was down as well. The cost of living squeeze is potentially going to get more people coming into the jobs market, because those who may have taken early retirement or stopped working due to COVID, now getting crunched in the pocket, may have to return to work in the jobs market, and therefore we're going to see employment rising. This could be a situation we also see in the US, although the cost of living squeeze isn't as great over there. If that happens, again, talking about the Fed, one of the areas they want to slow down is the jobs market. It could mean that takes a more prolonged time, because if more people are coming in just to get by month to month, obviously employment is going to continue growing, and we're not going to see the weakness coming in there that the Fed wants. Same a bit for the UK. If we continue to see strong employment, strong wage growth, although wages are negative if you take them on after adjusting for inflation. It's a similar situation, but the Bank of England are not so keen to stamp on the jobs market as the Fed are. So it would possibly be a positive if we keep getting strong employment in the UK there. A couple of other bits of news as well to play into the inflationary picture. Germany finally sort of agreed their gas levy to come in play October the 1st. This is what they're going to tack on to household bills to help the companies like Uniper and the transition from Russian gas to other sources. The levy equates to roughly a 13% increase on the average bill. The UK is also going to set their price cap again, which is going to go much higher. They're going to set that price at the end of August, which will be effective beginning of October. The important issue for this is that it's going to keep inflation hot coming through the pipeline. These energy increases are coming at fixed points in time, So while everyone's looking around for potentially peak inflation numbers, here we go with October, and we're likely to get an inflation boost coming in from those energy prices. That's not going to stop. That's going to continue, particularly in the UK, because they'll get reassessed again in January. And if they go higher again, then we're going to see further inflation. So particularly for Europe, you know, as I say, lots of people talking about when is peak inflation going to hit? You know, have we seen the top of inflation? We can't really take the swings month to month until we start seeing an effective trend in inflation either coming down. But this sort of news on energy prices is going to keep inflation very hot in Europe and the UK. So we may see some soft numbers between now and October, but then we're going to get that injection coming in again in October. That's all I've got on the headline front. I don't know, Kay, you've got anything you want to add or anything you've seen that I haven't?
No, not for what's
this morning.
just seen that the European what is it, electricity or so prices hit 500 euros for next year. It's that's just adding and adding and adding to what's going on. Next year power trades at 500 euros per megawatt hour for the first time. So no, it's just going to add to the weight around Eurozone's neck, I think. Because as I'm pleased to say, it's not because inflation rallies and ECB may be pushed to hike rates that the currency is going higher, because it's for completely wrong reasons right now that inflation is flying, right?
Yeah, and it also shows that it doesn't matter what central banks do; they're not going to be they can't fight this sort of inflation. They are pretty powerless to do so. And as we've been talking, you know, over the months ahead, you can talk about inflation being high and temporarily, and you know, there's a lot of short-term input from things like energy that may flush out pretty quickly, but it's how long things like energy inflation sit there for. You know, if it's a quick spike, then it doesn't have too much of an impact on core inflation, if you like, or feed through, pass through of these energy spikes. But because we've been sitting with these energy spikes and energy prices continually going higher, it feeds through. The pass through then comes through to everything else because it's not a temporary factor. So then firms need to account for this in their pricing. They fill up trucks, they power their factories. That cost has got to be passed on somewhere, and it gets passed on down the production line, usually to the end consumer. And that's when inflation becomes entrenched. So even then, central banks are pretty powerless to stop it with rate hikes. They can try and slow down demand, but fighting inflation is always like trying to tame a tiger, as they say. And particularly with the UK, it's a very tough job to do. And I don't know any times really when they've managed to get a handle on inflation. But that's the world we live in at the moment, you know, and central banks will do what central banks will do, and we'll just trade around it. So let's look at some of the pricing. Not a huge amount going on at the moment. I'm keeping an eye on $1. Obviously, because I got into a short yesterday. I did a final bit up at close to 6.82 last night. And what I'm looking at is we've obviously had this break here of 6.7879. This was really the decent resistance that we've been sitting watching for many weeks. We've had a break there. Got a bit of a line in the sand going back to the May highs just after the run to the 83s. So that comes in around about 6.82. That's a bit of a line in the sand for me, hence why my stops are 82.50. Just above that, if we do break above there, I'm likely to be out. It's looking like we're potentially holding the break point at the moment. 79.21ish, you know, just around where we've had these little spikes. I'm going to call that a confirmation of the break of this area here. We have got the potential for further rate cuts and possibly doing more, unless it's a reserve requirement ratio cut, which is the big one. The next lending cut that we were speaking about earlier may not have the impact unless it's a big move, like we saw yesterday. But technically, you know, yeah, we are holding above here. I'm thinking if I do get a move down to 6.79, I'm going to cut out a lot of the trade, take whatever pips I can grab on the average, and see what it does from that, and just run maybe a small piece for interest. Anything down to 6.78 like that, I'm going to be taking my money. Probably a bit too early in this trade. As I said yesterday, I don't like trading as soon as I come back from a holiday because I don't really have a feel for things. I did try it as a technical trade, hence why I haven't gone too big. But it's looking like I should have just sat on my hands for a bit. But we'll see where it goes from there. If we do get a break up higher through here, then we're going to be looking at some much bigger levels. We've got the 61.8 fib of the May 2020 move in the 6.85s. So again, a bit of a line in the sand there. If we get above there, we're really going to be looking at maybe having a push up to the 7s and up to those prior year highs, the big 7.2 up here, which is a fantastic double top that I know a few of us traded a few years ago when we were in the Forex flow room. And if we get a move up there, then I'll be looking pretty much to do the same thing again. Look at that area up in the top side, see if we get a move and a hold up there. You got any thoughts, Kurt, on this one on a wider picture basis?
Yeah, I'm the other way around. I think the break is likely on, and I'm bought really tiny this morning, and I'm looking to add on in the 678, 679.5 zone for a push up to 685, and then see what happens there. But because I think the PBOC waited for longer than the market was expecting, and that was helped. So the dollar China had a move lower, helped by those US CPIs the other day. But then gradually the bids came back in, and I don't know if it's going to happen below 677.5. I'll be gone probably, or 678 below. I'll be gone probably if it doesn't work. But yeah, I think it may somewhere be the start of the move that we were looking for a while now. So yeah, I'm rather the other way around. I think we're possibly at the start of something. So
yeah, and a perfect example of two slightly different train of thoughts, both trading, and in fact we can both make money on it if they both go our way within our own time frames and plans. Now, what should be important if you're trading the one is to keep, if you get any big moves, is to keep an eye on the headlines, because it's very important, because we do get comments from the state, be it financial regulators, the PBOC themselves, or anyone in China. For those that may not remember, when we got this big push up here from the 630s, we got to about 6.80, 6.82, and then we started getting comments from one of the banking regulators saying that the moves in the currency won't all be one way, and that pretty much marked the top for that particular move. It was right in here that we started getting those comments, and that was a market signal that China would only allow the currency to go so far for so long. So it's very important you keep an eye out, because they do signal their intentions as to currency moves, how far they're going to let things go. And that's another reason why you should keep a note of these fixes if you're trading the one, because if the market, or particularly the offshore one, moves higher but the onshore one doesn't follow, and they start keeping things contained by the fixes, then that could be a signal that they're not going to let the price rally too high, $1 rally too high in either market. That is a big signal if you're trading it as well. So one to keep an eye out on. Kay, do you want to do your little round robin?
yes, sir.
Let me stop sharing the screen.
Let me do. Okay.
And while you're setting it up, just want to answer Mike, who says, I don't believe the Fed will pivot because of the housing market. No, the Fed won't pivot just on the housing market. It's just one of the sectors. As I say, there's going to be a checkbox for every sector: manufacturing, employment, or should I say, every part of the economy, retail sales, housing, services. You know, they want to see demand dropping across the board, and particularly in employment. So as I say, they've got check boxes, and once they ticked all those check boxes, as they've destroyed demand sufficiently for them, that's when we're potentially going to have the topping hikes in rates. So that's the reason. So the housing market is heading towards their tick at the moment. The others have a lot more work to do.
All right.
Yep, go ahead, mate.
Okie dokie. So let's start with the euro dollar, the main one. Yesterday we gradually chewed through this 102.0510 trend line support. There was another one here which came in around 101.70, as I mentioned yesterday. So both of them are giving way. There's still a lot of weight around Europe's shoulder, but we have to respect what happened here a number of times where we went below this 101.30. So the 101.2030 is really pretty important for the euro dollar, and below there, and that's part of my updates. Probably lost this one. Below there, I had a 100.90 at some stage. Here it is. To me, this 101. It's around 101.10. Is another one which we came resting on a couple of times as well. So watch it. Likely 101 is going to be decisive for having a move lower or not. If for the time being we are respecting the level, I'm still a little short, but I've been really screwing back on it and replaced it this morning actually with a partial euro cat, because oils have been coming off quite a bit, but seem to start to find bids again in important support zones, and also with gas prices everywhere, and especially in Europe still pointing higher. I think the Canadian dollar is perhaps going to pause, not weaken further, but especially it's to replace euro dollar shorts by rather some euro crosses if the dollar doesn't continue strengthening. Yesterday's New York Empire number, as Ryan already said, had me doubt a little bit about the dollar strength. But yeah, I mean, price action is there. We're coming to rest on this 101.2030 again, and we'll have to look what the market wants to do with this later on. I think we are going to find sellers perhaps already on a return around 101.6570, where we kind of opened the day in the European session, and then more to come just above 102. The euro